Today, we're going to have, as I said earlier, Elliott Tracy talking with us. I'll tell you a little bit about Elliott in a moment. The recent signing of the stimulus bill that I'm sure you've all heard about is going to have tremendous impact once again, as these stimulus bills can, on businesses and individuals. And we wanted to bring to our clients and to our market, the dental professionals, the most accurate and timely information. So you have that, and you have or are aware of the tools that you need to navigate the various changes as we move into 21. So Elliott is here to talk about that. We're delighted to have him back. His webinars before have just been very, very well received. Elliott Tracy is a partner and key member of the healthcare and dental team at Jones Roth, a CPA group. They deal with dentists and healthcare people all over the United States. He specializes in providing dental and medical practices and their owners with practice like practice benchmarking, cash flow planning, business strategy, tax planning, and a great deal more. So without any further intro or ado, Elliott, let me pass it over to you. Take it away.
Yeah, thank you so much, Alan. I appreciate you having me on again to do another webinar with you guys. I've really enjoyed doing these and look forward to doing these again in the future. So yeah, so we've had a really interesting year just in general. I think the first one I did, we spent a significant amount of time talking about the Paycheck Protection Program and how to really maximize cash flow for practice owners during what was a really difficult time, and you know, trying to figure out how to best handle what we had in terms of COVID and offices being shut down, to now, you know, going a little bit full circle. I'm getting close to 12 months from when we really started hearing about COVID and what you know, what it could potentially mean. Again, we're not quite there yet, but getting closer. And a lot of practices, you know, in many cases are in pretty good shape, or they're still somewhat being affected, but you know, not quite as bad as I think a lot of us would have thought they would have been in at this time. And one of those is because of some of the stimulus packages that have been put together. And then, you know, really the Paycheck Protection Program, something like I said I kicked off with initially, was a big has been a big help for practice owners this year. So, but what I wanted to talk about today is talking about last minute planning opportunities. We're a few days from the year end, and there still are some things you can do even at this point if you haven't done them so far to minimize tax liabilities. But also, you know, maybe here's some ideas that if you're not doing that this year, you don't have the capability of, you're going to look at it in the future. So let's talk about last minute planning. Really, the goal for today is to understand, you know, what last minute tax planning opportunities, so what they are and what are available to you, and different things that you can do. And so I'll spend some time on that, but the plan here is to spend roughly 30-35 minutes at the most in terms of presentation going through these things. And then if there are any questions after the fact, or you know, during the presentation, you can definitely enter those into the Q&A, and I'll either get to them as we go, or I can answer them at the back end when we do have some time for Q&A. So first, webinar agenda. Right away, let's talk about the year-end planning opportunities, and then we're going to spend not a lot of time, but we're going to spend some time talking about the Consolidated Appropriations Act of 2021. This was what was just passed on Sunday, and it's kind of a funny name, so we'll give a little bit of background on that when we get there. But these are our two main topics for today. So really focusing on what year-end planning opportunities are available, and then we're going to talk about the new stimulus bill and how these things can help and potentially help or affect you going forward. So year-end planning. A lot of our year-end planning is going to stem from what happened within the CARES Act early on this year. So first, I'll just mention briefly what the excess business losses were. So with the 2018 tax reform, was the Tax Cut and Jobs Act, excess business losses were suspended. And so they were suspended and kind of held in a bucket, and then a business owner, a practice owner could take them going forward. A lot of times we didn't see a whole lot of losses within a practice unless it was related to some type of large depreciation deduction. Those are purchase of equipment or maybe a purchase of a new building, different things, and that caused these losses. The CARES Act removed the suspension of excess business losses, and what it did was, into a nice segue, is the net operating loss. So now, because we could have excess business losses, we were now, as individuals, able to create net operating losses. So because 2020 has been such a tumultuous year, certain practices, like I said, have been hurt more than others. Some have done better than others. But if you happen to have a net operating loss, the tax reform rules from 2018 said that you could only carry those forward. You could not carry them back. Carrying them back was something that was available before the Tax Cut and Jobs Act. So with the CARES Act, it brought these rules back, and it extended it even further and said you can now carry back up to 5 years. So if you had a net operating loss in 2020, you can go all the way back to 2015 to offset income from those periods, and any excess after that would then be carried forward into 2016, 2017, 18, and thereon until we got all the way up to 2020. And then any excess after that could be carried forward. So this was a huge benefit, and the reason they do this is to really is to create additional stimulus dollars. So if you have a loss, you can go back and recapture taxes that you had to pay. So that's what the result of that was. It was just one of the many things within the CARES Act. So the reason I bring it up is if you're creating a net operating loss this year, definitely have the opportunity to look back. Qualified improvement property, this is now back. And when I say it's now back and eligible for 100% bonus. Many times throughout this year, I have had multiple conversations with practice owners who have a building that they did a build out or some type of improvement to it from 2018, 19, or 20. Anything that happened in 18, 19, or 20, if it was to the interior of a building and it was not a structural component, it was considered qualified improvement property. That was depreciated over 39 years, which is the same as the building. And that's how the rules were set up in 2018 with the Tax Cut and Jobs Act. But with the CARES Act, they fixed this. There used to be 15-year qualified leasehold improvements. That's been replaced with qualified improvement property, and it is now eligible for 100% bonus. So what does this mean? It's just another one of many of those ways that you can recuperate the costs on a building from either brand new improvements or a refresh or something you've done within that is not related to your equipment. This is a 15-year asset, and so it is eligible for bonus, which means if you want, the practice owner can take all of that in the year that it was purchased or that it was constructed. This is a huge benefit. Again, it's a stimulus item. They're looking to reduce taxes so that taxpayers can conserve cash flow. Again, it's another one of those things that could create a net operating loss for you for 2018, 19, or 20, and then be carried back. Now, I have this note down here of a cost segregation study. This is one of those last minute planning things, and the beauty of it is it doesn't have to be done today, and it doesn't have to be done before the end of the year. So I'll give a very quick example. Let's say the practice owner has purchased the building. Let's say you purchased that building in 2018, and you did an improvement to that property in 2018 worth $500,000. What you can do with a cost segregation study is it takes the building purchase, it takes that $500,000 improvement that was made, and it breaks it down into different components. And those different components can be depreciated either faster or at the same pace as a building. A building, if you recall from a few moments ago, 39 years it takes to recuperate the cost of a building through depreciation. Most are not in their building for 39 years, so really you never get to fully recuperate the cost. So what happens when you sell it? You offset the proceeds, and the difference is capital gains. But there you can see the underlying issue is because you don't get the depreciation, you're exchanging an ordinary deduction for a reduced capital gain far into the future. If it's me, if I'm the smart tax person, I'd rather have the ordinary deduction today than the capital gain treatment, which might be 20 or 30 years, or even, maybe even 10 years down the road, but still recuperating those costs today by doing a cost segregation study is a huge opportunity. And again, if some of those components of that improvement fall into the qualified improvement, which is 15 years and eligible for bonus, or if it's equipment related, or if it's office related, anything can be depreciated more quickly, could potentially create a net operating loss, which can now be carried back to offset taxes in a previous year. So tons of opportunity around the cost segregation. And I want to note something. I used an example of 2018. So what happens if you do this and it's for something that was placed in service in a previous period? You can actually catch up all of the lost depreciation in 1 year. And that's why I mentioned is that it can be accelerated into 2020. So if you have a cost segregation done and it's done before the preparation of your 2020 tax return, you can take advantage of all that depreciation on 2020, and that can then be carried back to offset a previous tax year. So cost segregation studies can be a really powerful tool. And they can definitely create some big deduction potential. The employee retention credit, this was in the CARES Act. I'm going to skip this because we're going to talk about it here in a little bit with the new stimulus. It was initially not eligible for those that have received PPP loans, but that has now changed, and this percentage has also changed. So we'll talk about that in a minute. And the business interest limitation, most practice owners, if not all, unless you're one of the big groups, did not see any limitations. But if you did, because you maybe had outside investments that caused these limitations, they've increased the adjusted taxable income up, which essentially means you're going to get more of a deduction. So you'll notice all of these things right now within stimulus, it's either more credits or it's more deductions, and therefore reducing your tax liability. So tax planning opportunities. So here's another one. I talked about what was specific with the CARES Act. Here's some general things, with the exception of one of them that is kind of an every year thing that you want to make sure you're doing. And many of these you can still do. I know we have only a couple of days left, so it might be hard, but there are specific things that you can still do. The qualified business income deduction. So qualified business income for healthcare and dental, you're in a specified trade or service business, which means you have specific phase-out limits. If your taxable income as a joint filer exceeds $326,000 and $600, or $163,600 for all others, which is head of household and single. Once you get to that point in taxable income, it starts to phase out, and then it looks at different limitations and only allows a specific amount of the deduction. Once you get over $426,000 of taxable income, you're completely phased out and you're not eligible for this deduction. Just a reminder what this is. This is a 20% reduction on the income from a pass-through or a Schedule C. So Schedule C S corporation partnerships that are a qualified trader business meaning you're in it for profit. You can receive a 20% deduction as long as you don't exceed specific limits. So why do we talk about this? The dollar amounts associated with if you can get yourself in these ranges is significant benefit. So I'll have a specific example. So here's a married filing joint couple with $200,000 in wages, practice income of $250 versus, and this is in the no planning column. So in this case, they showed up in April, they did their taxes, and this was the result. They receive a qualified business income deduction of only $700 because when you look, their taxable income is roughly $425, and then set $425 without the qualified business income deduction. So they're in that range. They're almost mostly phased out because they're almost at that $426. The tax is $98,000, which is a marginal tax rate of 35%. Now, with just some very simple planning, you can see where, and this could be anything. This could be retirement, this could be depreciation, anything, and I'll walk through what those potentially could be. In this scenario, we're able to reduce the practice income by $50,000, which reduces their taxable income down here. Because their taxable income is lowered and they're less on the high end of the phase out and more in the middle of the phase out, you'll see the $20,000 qualified business income deduction. So they are now eligible for a higher deduction because they were able to reduce their income. This 20% is based on the practice income. So you see the maximum amount they would be eligible for is $40,000. But because they're in that phase out range, they only get $20,000. But that $50,000 that was spent, whether spent on equipment or on retirement or whatever, you'll see it lowered their taxes by nearly $23,000. They're in a marginal bracket of 32%, but you see the tax savings because of the qualified business income deduction, it multiplies. So instead of it being a 35 or a 32% savings, it's actually a 45% savings. So really big piece, something I want to make sure I emphasize, there are still possibilities here, even after year end with things like retirement contributions that can be done to get your liability down. But if there's things before the end of the year, like equipment purchases, other, there are still items available to you. And maybe the cost segregation is something that can help you, because that cost segregation, that could be on another piece or another business activity. You could still have qualified business income from another place and receive some benefit. So I wanted to make sure I walked everyone through on that piece. Donor advised funds, so as everybody's aware, the standard deduction has increased significantly with the Tax Cut and Jobs Act from 2018. Donor advised funds are becoming more popular. What this is under current law, you are able to put money into this donor advised fund. It can be invested and there can be investment income on it, and you're not taxed on it because it's in a shelter. It'll, once received, you get the charitable donation at the time it goes into the fund. It can grow tax-free, and then any distributions made to charity are not taxed to them, not taxed to you as the person who as the donor that put it into the donor advised fund. So a very nice tool. The other thing, it's really good for potential estate planning to get some assets out and to get them into a vehicle to where you can distribute them as you want. You're not required to distribute everything in the year that you make the contribution. So one of the things we've talked about as a nice planning tool is, let's say you give $15,000 a year, but you're just barely getting benefit because the standard deduction for joint filers is almost $27,000. If you then decided, well, I'm going to give 15 every year, this time I'm going to give 30,000, I'm going to put it in a donor advised fund, I'm going to give 15 at the end of this year, and I'll give 15 at the beginning of the following year, you still get that $30,000 deduction. And so you're maximizing your benefits from the itemized deductions where you wouldn't be otherwise, because maybe you're just barely exceeding the itemized deduction. So another nice planning tool, something that can be set up quickly at the end of the year, as if things are able to get established and then make payments to it by December 31st. Bonus depreciation, we've already talked about this a little bit, and I just want to reference it again. So what this allows, it's very similar to Section 179, which we'll talk about in a moment, but bonus depreciation will allow a practice to create a loss. And so that creation of a loss is because it's 100% expensing after December or September 27th of 2017 through January 1st of 2023. At that point, once we hit 2023, you'll notice the bonus amount goes down. It goes from 80 to 60. All this means is that the amount you get to expense in year one begins to be reduced. When it's 100%, that means you can reduce your income by 100% of the cost in the first year. So this is available to new and used purchases, but it has to be new to you. You cannot buy it from yourself and start this over. It has to be something that is new to you in the use of the practice. But a great opportunity. Section 179, very similar. The only difference here is that you are not allowed to take a loss with this. You can go up to 0, and then when it gets to 0, it will limit your Section 179, putting it in a suspended bucket and carrying it forward to offset other income, or offset future income, excuse me. But both things, really big benefits. They're still available to you. The reason we call these last minute is because you can purchase both of these, any kind of equipment at the end of the year, but you don't have to make a decision of what you want to do until filing time. So there's still some time to make decisions, as long as the purchase of the asset has been made by the end of the year and it's been placed in service, which means it is being used within the practice. Retirement planning. So if you have a retirement plan set up, making sure that you're maximizing your deferrals and making sure you're maximizing 401k, doing all of those things by the end of this year, those can still happen. I just did this today with a practice owner. They had their deferrals. They only met about half of the deferrals because they stopped taking payroll when they were closed for part of the year. So when they were closed, they weren't making their deferrals. As a result, we're looking at things today, and they're about $5,000 short. You can still run a last minute payroll as long as the amount was included in 2020. It is effectively there. The contribution can then be sent, and there's the opportunity to maximize. By doing that, you can maximize, like I said, your deferrals. If you're over the age of 50, it goes up for a 401k to almost $25,000, then, or $26,000, excuse me. And then for the employer contribution, you can do up to $37,500 of additionals, or 25% of your compensation. So you have to have enough W-2 wages if you're an S corp, or if you're a partnership or self-employment, enough earned income to do it. But just because you haven't done it during the year doesn't mean you have to stop and you can't get it caught up. You can definitely get it caught up by doing a bonus and then making the contribution. So I would encourage everybody to do that. It's been a kind of a tough year, but there's still those opportunities there if you're doing them by the end of the year. This is another big one. This was one that kind of snuck up on us at the end of the year, but it is still available. The key here really is that you can make a non-taxable payment to your employee, so it does not have to go through payroll. It's considered a reimbursement to them, and it's a tax deduction for you as the employer. The key here is because really all it needs to be is reasonable expenses related to COVID. And I look at that, I spelled COVID wrong. You think I'd seen it enough. So related to COVID, those can be anything from home office, childcare because of COVID related expenses. There are all kinds of things, as long as they're reasonable, necessary expenses and a direct result of COVID and the qualified disaster that we have, they are reimbursable expenses. And the advantage here, the biggest advantage, is it doesn't have to go through payroll. So we've seen a lot of practice owners do this in lieu of having a bonus that has to go through payroll, which will cost the employee income taxes and will cost the practice owner payroll taxes. So something that we've definitely been doing for the last part of December. And if you have any questions there, let me know. It is a really great piece, and there's a ton of opportunity by doing the qualified disaster relief. And like I said, there's still time to do it. And there's the potential too, if we continue to be in a qualified disaster, which likely, it's highly possible we will be. They just extended out the pandemic unemployment assistance through March 31st of 2021. So by doing that, I imagine we'll still have this opportunity available, and something that you could do the first part of 2021. And like I said, many have been doing this in lieu of a bonus because of the benefits of the deduction and not having it be taxable by the employee. So now so those are again, like I said, a lot of these are general every year sort of things, except for the qualified disaster relief. That's something that is brand new to this year at least. So those are some really good last minute planning things you can take advantage of. I want to now take some time to talk about the the Consolidated Appropriations Act of 2021. And what this is what was just passed on December 27th of 2020. It was signed into law late Sunday evening by President Trump. And it's been hanging out there for quite a few weeks now. So there's a lot of things we've been hearing, but really what does it mean for year-end planning? There's a lot of specific things within there that affect both 2020 and 2021, even though it's in the 11th hour of the year. So really big pieces. I don't have any slides on this. I actually have an article that was recently written and posted to our website, which Alan and his team have offered to share with everybody following the time we're done here. But I'm going to go ahead and do that. I'm going to go to this article, which is this one here, and I've got it up. So the new stimulus bill, what is this and what does it mean, and why did they call it the Consolidated Appropriations Act of 2021? Well, it is 5,593 pages. And the reason is that it not only included a lot of tax provisions, but it included a lot of government spending. And so the two bills were coupled together. They had the stimulus benefit package and the government spending package were all coupled together and passed as one thing. There's many individual and practice rebates that are opportunities that are within here. I want to talk about a couple of those really here for the next 5 or 10 minutes. And they are the big ones. They're the ones that you're going to hear about and the ones that likely have the biggest impact to you. The first is round 2 of the recovery rebates. Now, what this is an individual will be eligible for $600 or $1,200 for 2 joint filers, and then $600 for each individual dependent. Now, there is additional discussion of providing more of a rebate. We probably all heard the comment as, I want $2,000 for individuals versus what was in the bill was $600, which was the same thing that we saw at the beginning of the year when the CARES Act was done. Now, why is this important? Many high-income earners did not get this, and high-income earner they consider for a joint person to be $150. Many did not get this back in March because it was based on the 2019 or 18 tax return, whatever was done. Now, let's assume this year's different. Let's assume now you have a cost segregation, or you have something that you've done that's reduced your adjusted gross income, like a cost segregation study, down to below 150. Well, you will not only be eligible for this new rebate, you will also be eligible for the rebate that already happened. And so let's say you get below the 150 as a joint filer, it's you and your spouse, you'll be eligible for $1,200 2 times for $2,400. If you have children, that's another $1,200 because of both the beginning and the ending. So there's definitely an opportunity here if your income for 2020 is less than it is for 2019. And so that's something, if that's the case, you'll get a refundable credit on your tax return, on your individual tax return. So big piece there. There is an extension of the federal unemployment assistance, so PUA, $300 per week for the next 11 weeks, which comes right out to about the end of March. The Paycheck Protection Program, and we're just referring to it as round 2. What they've done is they've added additional $284 billion, which is about half of the first round of $500 billion. There is now a Paycheck Protection Program round 2. And that round 2 is only eligible for employees or employers who have fewer than 300 employees and have realized a loss in gross receipts or sales or collections, whatever type of business, of 25% or more in any quarter of 2020 when compared to 2019. So for most practices that I'm looking at and talking to, this is Q2 of 2020. Your second quarter when compared to 2019 is 25% less. And most of the time that's because you were shut down for 8 weeks. It is likely the quarter that you will look at to see if you are eligible. And that is how the wording is within the law. Excuse me, 25% or more in any quarter. So keep an eye on that. By my calculations, I could be a day off here, but my calculations, the law was enacted on the 27th. 10 days later puts us at January 8th. At that point, lenders will need to be ready to provide this round 2. So you have some time to start getting information together, talk to your accountant, but more importantly, talk to your lender. They are the ones who hold the keys to getting a second loan. It is not going to be with the accountant. It is with the lender. It's not not with the SBA. So reach out to them. There's a couple of other pieces in here. So if you had an existing PPP loan, we've all been waiting to see if they'll increase the threshold for this simplified forgiveness process. They did. It is now $150,000 or less in loans. Really, when that's the case, you're checking about 5 boxes, putting some initials, and noting that you used it for all qualified expenses, including payroll. So that's a big one that really saves a ton of time for practice owners and the forgiveness process. Last one, and really honestly, most importantly, and this is the best year-end planning news we could have received, was that the expenses now related to PPP is tax deductible. So why do I say that? The PPP loan was always tax-free. And it was always tax-free. That's how it was written into the law. But once that decision was made, the IRS made the argument that the expenses related to those proceeds that are forgiven would not be deductible. As a result, so if you have $100,000 in income, you have a $100,000 PPP loan, the PPP is forgiven, you now have $200,000 in income because it is taking away $100,000 of your expenses. This new bill that was passed made that correction, and they're allowing the deductions. So the biggest benefit here is practice owners will get the increased basis from the tax-exempt income of the PPP loan and then a tax deduction. This was a huge windfall for practices. And I saw it. So if you're a $150,000 loan, depending on what your tax rate is, you saw just a moment ago, there was 32% or 35%. I've been seeing anywhere between $50,000 to $75,000, depending on what your state rate is, in benefit. And so that is taxes that you do not have to pay now as a result of this change. So it was a huge, huge benefit. I talked about a couple of the others. So a couple of the other main ones that this group is going to care about, that's going to be most important. The extension of the refundable payroll tax credits because of paid sick leave and family leave. So this was from the Families First Coronavirus Response Act, which was the second or third right after the CARES Act. They've extended this out to March 2021. What this is that if you have a specific number of employees, now many dental practices were able to opt out under some certain rules from the Department of Labor, but most have been paying this. And so if you're paying sick leave because somebody is either exposed to COVID or they have to stay home because of COVID and care for a sick person, they fall under this, which means you can offset the payroll taxes with tax credits and therefore not pay them, and it even is refundable if it's more than the payroll taxes you would pay. So huge benefit there. That's a nice extension out to 2021 and a definite tax saver. The employee retention credit, this is another fantastic opportunity. This one though, some practices will be eligible, some will not. Here's the big changes. The credit is, instead of 50%, it is now 70%, and they increased the limit from a per employee wage from $10,000 per year to $10,000 per quarter. Excuse me. So if you think about this, under the old rule, your maximum credit was $5,000. Now, potentially, let's look at the third and fourth quarter of the year. You get $10,000 for each of those quarters and a 70% credit. But you have to have a reduction in year-over-year decline in your gross receipts, so your collections, of 20%. So you have to be 20% down for the year to be eligible. Some practices are, many though, however, are not. So there's a high probability you won't be eligible, but some definitely could be eligible for this. But that's the big piece. This was the biggest change because nobody I saw really was eligible for it initially because of the 50% reduction unless it was a restaurant. But now the 20% helps out a lot. Also, the last and biggest change regard to this, it provides employers, so if you received a PPP loan, initially they said you're not eligible for this. Now they said you are eligible, but only on the wages that were not used for PPP, the forgiveness process. So you are eligible, you just can't use it on, you can't double dip, and you have to have this decline. I'm going to skip this next one. We didn't see a lot of taxpayers, or we didn't see a lot of individuals who ended up deferring their own payroll taxes and are now having to pay them back, so we'll skip that. But another big windfall for individual practice owners, you'll see meals have always been a 50% deduction. They are now a 100. So beginning on for restaurants between January 1st of 2021 through December 31st of 22. So a 2-year period, 100% of food and beverage purchases that are provided by a restaurant. So they're obviously avoiding the grocery, the store type scenario. Like they want it to actually, now I don't believe you're going to have to eat in the restaurant. I believe if you order from the restaurant, that's going to qualify, but we'll likely get some guidance on that. But you'll get to deduct 100% of that, where initially it was always only 50%. So you lost part of that because they considered it recreation or entertainment. They've changed that. This is a big stimulus item for those businesses, so that somebody is not skimping on that piece. If they're budgeting, they're going to take food and beverage out of the budget because they only get a 50% deduction for it. Now you have a 100% deduction again, so there's a ton of benefit there. Those are the really important things that I had that are from the stimulus and the opportunities that are available. My big takeaways for practice owners is the food and beverage piece, the 100%, the potential of a PPP round 2, and then maybe if by chance there's a potential recovery rebates, not only on the first round, but also on this new second round that was enacted. So that's all I have here. I think I'm right at the 30 minutes that I promised. And I do have a couple of questions. I'll look and see. I don't see currently any in the Q&A, but if you do have any items, please go ahead and post them in the Q&A or in the chat, and I can answer those. But 2 questions I had, and one of them kind of relates to what we were just talking about. So stimulus credit. Most who are eligible, the question is do I get it in 2020 or in 2021? It is based on your 2020 tax return. You will get it in 2021 once you file your 2020 tax return, assuming your 19 or 18 return, you're not eligible. Now, at this point, they're going to look at 19. So if your income was too high for 19, the government's not going to automatically send you one. But if your income goes down for 20 for any of a number of reasons, then you would be eligible for that stimulus. It'll be on your 2020 tax return, and you'll receive a credit that could potentially be refundable. So there's that one. The other one, and this was a really common piece, and so I want to make sure I share this, is we had a question, and I'm seeing this question quite a few times actually, is what if I already purchased equipment and I purchased equipment because the PPP was going to be taxable, quote unquote taxable all along. So if if you purchased equipment thinking this was going to be taxable, what you can do is a couple of things. One, you can still maximize your depreciation, and then you can either create a loss and carry it back, or there are options. Like I said, Section 179 and bonus are 2 things that you can opt out of, and you can take regular depreciation. So if you purchase these items, it doesn't mean now that you've lost the benefit of them, but you can actually spread out the benefit by electing out of bonus, then not taking Section 179. If it's a dental chair, for example, or maybe you purchase a scanner or x-ray machine, something that can be spread over the next 5 years as equipment. Usually it is front loaded a little more heavily, so you're going to get more in the first year, but there are the benefits of the next 5 years. So that's a big one. You have some options there, even if you've already purchased the equipment. You can create, like I said, I'll just reiterate real quickly. You create deductions this year. You can potentially create a loss and carry it back and offset higher tax years, or you can slow the depreciation down by electing out of some of these accelerated methods and then carrying it forward. So those are 2 really good options if you've already made those equipment purchases. So those are all the questions I have that I have seen. I don't see any new ones in the Q&A, but Alan, other than that, I really appreciate you having me on here for this webinar today, and always look forward to the next opportunity you and I get to chat.
Elliott, great. Thank you so much. That is wonderful material, very, very timely, and particularly helpful. So thank you again. For anyone who would like to contact Elliott Tracy directly, I want to give you his email. It is etracy@jrcpa.com. That's Tracy, Tracy, at jrcpa.com. We love having experts like Elliott pass along this kind of very high value information to our clients. And as many of you know, we have a tremendous amount of content that will address any area of your practice. You can go to our website that you see here and contact us. And you can also go online and sign up for a free in-depth consultation. We'll utilize our resources to address any of your specific needs. So thank you very much and look forward to seeing you again.